All right. So today, how to maximize profits on option swing trades while reducing losses. All right. Since a lot of people kind of got freaked out in the last couple of months with the Iran thing and the market dropping, we're going to spend a little bit more time on that today on the last 2 months and take a look at how I'll go over how some trades played out, especially with time decay, because some people were really concerned they couldn't they were so focused on the news and fear and everything, the market's going to go down forever type of thing, that they didn't take the long trades when they came up valid. So we're going to spend some time looking at that and see how things played out. The people who followed our plan did great. The people who were just too afraid to push that buy button, well, they got to make stuff up a little bit later on. Not big losses or anything, it's just drawdown, and they could have had a really great month of April, but fear of pushing that buy button. And so we'll talk about that. That's a real important thing to be able to do. And the way we trade, it makes it a whole lot easier. All right. Everything we're going to be going through is for educational purposes only, not giving you any specific trading advice. What we're showing you is how myself and Becky is the co-host, she's my trading partner. Anything you see in a box, any stats, any spreadsheets. She's the one who puts that together, maintains all the numbers, and knowing probabilities of success for different things is how we trade, is how we know to make money, is how we know how much to risk. Because if we know that there's a 87% probability of this happening. Now we know if we risk this much, we're gonna so many times and so many times we'll take so many losses. Each loss is this much, but each win is at least this much. Then we know we can make money. But having those numbers is so key, and that's understanding the big picture of trading and not just what's in that moment. And we'll talk about that a little bit later also. A little bit more here. These are the sectors we trade with these particular ETFs. There are a handful more that we could trade. We don't, at least not yet. So we chose these because it's a very diversified set of sectors that gives us a little bit of everything, including international exposure. And they have enough options and option open interest to make it tradable. There are probably 1,000 different ETFs out there, but most don't have options or they don't have options with enough volume and open interest to make them realistically tradable. But these are pretty liquid, and there's something for every size account. Options might run anywhere from 100 something dollars a contract up to $3,000 a contract. So there's something for everyone and every account size here. That's why we have a very diversified list. So now I'm going to talk about some big picture stuff, which I'm going to start out with. I'm going to switch over to the charts along the way. Stop me, interrupt me, unmute, ask a question, or type in the chat window, and I will see it eventually. Like I said, in the chat window, you'll also see the link to the handouts. So I'm going to switch off now to the live charts and go over some of the big picture stuff, which we usually start with, and then see where we are right now and take a look at that fair thing that happened over the last 2 months. All right. So what you're looking at right now is a monthly chart of the S&P 500. So every candlestick is 1 month of time. Here we're back in 1999. This is 1999 here. All right. This blue line is a 40 period moving average. You're going to see a 40 period moving average in just about all of our charts. We started using that when we met a gentleman named Oliver Velez, and he had a 40 period moving average on everything. And we had kind of adopted it as we were trading and doing our analysis. We found it a good way to determine trend and also a line in the sand above or below it, bullish, bearish bias, that type of thing. So you'll almost always see a 40 period moving average on our charts, whether it's futures, forex, weekly, daily, whatever it is, options, you'll see a 40 period moving average. This is an 8 period moving average. Learned this from certain multiple people, but especially John Carter and Hubert Centers. And on multiple time frames, we'll see the same thing. So when price is above the 8, it will pull back to the 8. It will pull back to the 8. It will go up and pull back to the 8. And every pullback is a buying opportunity. Once we get a couple of consecutive closes below the 8, it will retrace back up to the 8, back up to the 8, back up to the 8, back up to the 8. And every time it goes back up to the 8, it's a shorting opportunity. Now, we don't take our signals off the monthly chart, we take them off the daily chart. The daily chart is what we specialize in. But we will look at the monthly chart to take a look. Hey, it's coming back down. Let's take a look at our daily chart to get our trade signal. And that's all of our strategies will give us our trade signal. So we don't just, now if you're a longer term investor, we'll talk about that. That might be a little bit different, but more shorter and medium term, we don't just go short or buy put options because the market's going up. We have to get to a certain point where we have a high probability trade when it gets up here, and then once we see a sell signal, then on our daily charts, then we go short. And so you can actually use this and trade it up and down, and it works really, really well. Serena,
Oh, sorry. What does EMA mean? I'm sorry if I missed it.
EMA is exponential moving average. So
Oh,
there are dozens of types of moving averages. So for this chart, it's 8 EMA and 40 EMA, exponential moving average.
what's the difference in the blue and the orange?
The blue line is a 40 period moving average. So it creates one new data point every 40 candles.
Okay,
And the 8 period EMA, it creates one new data point for every 8 candles. So it's a faster. So this one is blue line is slower. The orange line is faster.
got it. Thank you.
Right. So this was the crash of 2001 tech bubble burst and everything just collapsed. It doesn't mean there's no up for the investors out there, well, they got crushed. For the traders out there, if you know what you're doing, you capitalize on this move down. Then we got back above the 8. Every time it's above the 8, pull back, buy, pull back, buy, pull back, buy, pull back, buying opportunity. And once the 8 crosses the 40, even better. Every pullback is a buying opportunity. Every pullback is a buying opportunity. Once again, we take our buy signals off the daily charts, but we kind of monitor these each week, month to see when it's pulled back, and then look for the buy signals off the daily charts. That's when we get our best opportunities. All right, this was our 2008 crash here. The market dropped literally 50% in just a couple of months. 50% drop in the market, literally 50%. Um, if you know what you're doing, you capitalize on this move down. If you don't know what you're doing, most investors just hope for the best. And if you live long enough, the market usually comes back. But this is years that go by for the market to come back. And it did. But from our point of view, we should be making money during all this time market's going down and making money all this time the market's going up by following our strategies because they give us buys and sell signals. Just follow the plan. All right. So this is 2010 here. We went back in this bullish crossover. This was back in 2010, and every pullback, 2 consecutive closes below the 8, the market kept going down. And I can show you ways to capitalize on this next pullback. And if we ever see 2 consecutive closes below the blue line, the 40, the monthly 40, the market is probably going to be going lower. Okay. So we haven't had that in a long, long time. But every pullback buying opportunity, every pullback buying opportunity, these are all can be traded with shares or with options. We choose options. I'll show you a way to do it with shares, but it requires a little bit more capital and attention sometimes because you have to put an exit order in. It's not just buy and hope for the best, it's buy and take profit at a certain point. So people I'm working with who want to trade shares, I'll show you how to do that. If you're trading options, then that's what we do. Okay, here we are, 2018, pull back for a couple of months, and then this blue line, when it hits the blue line, this is for the long, long-term investors. Every single pullback to the uptrending 40 period moving average is a buying opportunity for the long, long-term investors. You just sit and wait patiently. When it happens, you're going to see in the news something horrible is happening to the market. It's making the market drop and drop and drop. They're going to make you feel like it's going to go to zero. It's going to be a repeat of 2008. That is what they're going to be doing. And you just have to be salivating and waiting and waiting and waiting for that pullback to that moving average and get long. If you're long-term investors, you're buying shares. This works in the S&P, Dow, and Nasdaq, not individual, not all the other sectors, individual stocks. It's the major indices. This works extremely, extremely well. Long-term investors, here's your buy point. Medium-term investors, every pullback is for the medium-term investors. You just track that, and then when we get the signal on our daily charts, you go long. Here we are so it's 2016, pullback, every pullback. Not exact, it's going to be anywhere in this area. As it's pulling back, anywhere in this area is where you start setting up your long-term positions. That might mean scaling in. You put one third of your position on, it goes a little bit lower, you put a second third on, it goes a little bit lower, you get put a last third on. So you start scaling into it. Okay. So here we are. This was COVID. This COVID pullback. This pullback lasted a whole 3 weeks. And once again, people were so afraid things were shutting down. Um, that's why I don't care about news. Don't look at news. Turn it off. Um, I look at pure technical. We're pulling back to the uptrending 40. And this is one of the biggest rallies in market history. This just took off. Short-term pullback lasted about 3 weeks and then it just took off. All right.
Excuse me.
Yeah.
So if it doesn't matter if a wick or the body of the candle touches the pullback, touches the blue line, it's still considered an opportunity.
For bigger picture stuff like this, it's not exact because it is a moving average and this is moving throughout the month. What you're seeing is where this is when the month is over. Um, During the month, this is moving up and down, up and down, up and down, this moving average. So what you're seeing is where the market closed. At some point, this red candle was all the way down here. This close was all the way down here at some point in time during the month. And
When
then,
where did it close when you look at the candle? Because it's a range or
yeah, so it opened up here. That was on the first of the month.
uh
That was in December of 2018. I'm looking at 2018 right now. This is 2018. And it closed right here.
oh,
But sometime during the month, it went as low as down. This red
got
was all the way down here at some point in time during the month. And before December 31st happened, it came back up and closed right here.
it. Hmm.
So at some point, anywhere in this area, you would have to start establishing a long position.
So is the
We,
top of the candle like because it closed lower than the opened, it's red,
yes, since it closed lower than it opened, it's red.
and the
Um,
next candle closed, opened at the
Higher,
bottom and closed at the top.
exactly. You got it.
Okay.
And in between is all the turmoil you'll see in the news every day. But when we look at the big picture, all the turmoil, everything in the world that happened that month, good, bad, otherwise, is summed up in four numbers: the open, high, low, and close for the month. That's it.
Mhm.
So when we look at the bigger picture like this, you always go like, what's the big deal? This is so smooth and simple. That's why I like to see the big picture so I don't get afraid anymore. I understand the big picture. So I'm salivating and waiting when the market is going down. There's something horrible driving the market down, but I'm like waiting here. Yeah, get there, please get there so I can go long. Okay? Because that is an opportunity. This is, like I said, this was the COVID pullback. It pulled back, it actually went lower, but then it came right back up and just kept going up.
So you're not doing any short positions then?
There on the daily charts, there are going to be multiple short positions,
Okay.
multiple shorts going on throughout this whole move down, and everywhere in between. There's going to be short position on daily charts. This is monthly,
Okay.
so this is the big picture, but we get down to weekly and daily, so we do our signals from the daily charts. But the big picture gives us an overall feel, so we don't get shaken out or out of despair. Because on any given day or two or three, we might have a big down day in the market, and the folks on the news will blow that up and disproportionately, and make you think the market is going down forever. They inflict fear on people for whatever reason. That's what they do.
Mm.
And that's why I say don't listen to the news, look at the big, oh, it's nothing. Here we are when the war started, end of February, beginning. So this is February, March, and this candle is April. We had a meetup. It was either the end of February or beginning of March where this candle was down to here, and we were literally sitting on top of this orange line. We were literally on this orange line. Okay. And we had another meeting where we went below it. And I told people, look at where we are. We were literally sitting right here. Here is where you start looking for a buy signal. Start looking for that buy signal. Throughout this is the month of February, excuse me, month of March. And there's fear on TV. There's war this, oil prices this. And I said during the meetup, I would actually like to see the market pull back to here. If it does, opportunity. It's about 10-15% pullback. You heard on the news, they're going, oh, we're in bear market territory now. The market has dropped 10%. Ignore that nonsense. That's just standard um, stuff they tell whoever's reading copy to say. They are people reading the copy have no idea what that actually means. News people, someone writes something for them and they read it. And whenever this happens, pull back 10%. We're in a bear market now. No, ignore the people on the news. Understand the big picture. And this creates opportunity. So I tell people, wait for a buy signal. We're not just going to get long here. We wait on our daily charts for our buy signal and then get long. And the buy signals actually came towards the end of March and the beginning of April. We had a couple at the end of February, so it went against us for several weeks and then took off. So it went again. So we had a couple of buy signals at the end of February, right about here. The market went against us for a few weeks. Here's the benefit of options. You don't have to have a hard stop loss. What you pay for the option is your max risk, and it has 2 to 3 months worth of life to it. So it has to just reach a target, our profit objective within 2 to 3 months, usually. So the next month, April 1st, we got our buy signals, and all of them came April 1st, basically. And it took off. We got our buy signals on the daily chart. Now I'm going to switch from the chart here. But remember, this is all fear. People thought it was going to go down forever. Oil prices, everything else. People forget. There is no one single thing on the planet driving the stock market.
Mm.
There are many things driving the stock market, but people tend to focus on what particular topic the news organizations are talking about that particular day or week and think that's the only. No, there's many things driving the market and including earnings. And this is the month earnings started. April is the start of earnings season. Company earnings driving the market. Yeah, there's a war going on. There's always been a war going on. They say there's turmoil in the Middle East. There's always been turmoil in the Middle East. Okay. So just because they're not talking about it in the news a particular day doesn't mean it's not still going on. So don't get caught up in news. I'm going to switch off to the
So
actual.
for, I'm
Yeah.
sorry, for this strategy, we don't need to even consider like the 1 hour, 15 minute. It's just weekly and daily.
Yes. Forget the actual trade signal. So this is the big picture look, just to get to stay sane. Now I'm
Mhm.
going to switch off to the trade listing, and then you'll see the individual trade shown. Okay, so here's our spreadsheet of the trades over the last few months. I actually have all of 2026 here on 2025. For 2026 so far, here's what we have. 91 trades on a daily, this is all daily charts now, not weekly. 90 something percent of our trades are on the daily charts. And that's the bread and butter of what we do. is the daily charts. This is what we do. We've been doing the same type of trading for decades now. We started this type of trading in like 2007. It really hasn't changed since then, how we trade and manage positions. It hasn't really changed. It works. Once you find something that works in the market, you stick with it, period. You just stick with it. It can improve on it, but you don't change the foundation or whatever works for you. So this is overall numbers and stats, 91 trades so far that have either reached the first target or expired worthless. That's as of last week. And here are the short trades, here are the long trades. Just because something hits now with options, options have time decay. We're just buying calls and puts. The thing is, we don't care about time decay. The reason is we don't care about things out of our control as long as we follow certain rules. The time decay would be a major issue if we were buying stocks because the stocks have a lot more implied volatility and they can go up or down very quickly and suck all the premium out of the option price. With the ETFs, I think we have a few new people in the room, so in the meeting. So check the chat window for the handouts. Anyone who came in the last 10 minutes or so. So with ETFs, they're a basket of stocks. One ETF might represent 100 different stocks. Like the S&P 500 is the SPY ETF, and that ETF contains 500 stocks. So no one stock can influence everything so disproportionately that it takes over. So there is less volatility trading the ETFs than one particular stock can move 30, 40, 50% in one night. And it occasionally does happen. But that's not the same thing with the ETFs. The ETFs don't move more than a couple of percent one way or the other over a given period of time. So it's a lot less volatility, and that doesn't kill our option pricing like stocks do when volatility drops out of it. So we had a lot of trades, valid, long, and short. So we had a lot of long trades. All of our short trades were hitting through as the month went along. This handout is also on my website, so you can check the website. The spreadsheet's on there. You can download the spreadsheet itself and take a look at this later on. You can sort through it. You can arrange it any way you want. There's trades that go back all the way to 2019 and some of the other spreadsheets, so you can download and sort through information as you would like to. But as the market was going down in February and March, we had a lot of trades hitting targets, and we had some long trades going against us that were valid earlier, and they were going against us. And as they went against us, the reality is some of those trades didn't hit the first target until expiration Friday in April. And they saw about a 25 to 30% loss in premium from time decay. We had the trades on literally for 2.5 months, and they saw about 25, 30% in time decay. Why I say big deal? Because there are new trades being placed. New trades, like all of these longs that became valid in March, have all been hitting targets and bringing in new premium, new profits. At the ones right on March 1st, and there are a lot more than these. The ones you see are just the ones that are 84% and high. There were a lot more trades actually valid. We only deal with stuff 84% wins and higher. At the end of April, at the end of March, volatility was still so high that the targets are based on average true range. Our targets are based on the amount of volatility in the ETF, and it's bigger ranges. We have bigger targets. So where we might normally expect to get a 15 to 20 something percent return on a trade at the first target, we are seeing 20 to 40 something percent return on a trade at the first profit target. Because of the bigger volatility. We love volatility. The more volatility we see, the better it is for our type of trading because it makes our profits bigger, because it makes our profit objectives and targets bigger. So we want volatility. So as the market was going down, down, down in March, I kept telling people, you wait for our buy signals, wait for our buy signals, wait for our buy signals. We were still getting short trades valid even through the middle of March. Great. They hit the targets. Perfect. The Qs and NASDAQ. We have multiple short trades hitting. And then we started getting buy signals. This was the beginning of March. They went against us for 4 weeks. Big deal. Besides the ones you see here, there's another thing we call market internals. They were becoming valid for long trades also. Those you don't see in the chart, it's a different type of sentiment trading. So we had multiple things saying long. And then, most importantly, April 1st, we had a whole bunch of long trades all become valid at the same time. And then then a little bit later, a few more trades valid. Where you see it says Ichimoku hook is the name of one of our strategies. It's our single oldest strategy. We've been trading probably for 19 years. It is a trade setup for finding market bottoms. It only comes up valid after a market has declined for several weeks. And then we see this hook. Hook trades are something myself and Becky, my co-host and trading partner, learned from people when we first started trading different types of hooks. So the market's going down, 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 whatever it might be. And then something just goes up the hook. And that's the first opportunity looking for a turnaround. It might just be multiple standard deviations down and hook. That's our opportunity. That hook, that's our trade. And that's the way it is with Ichimoku hook. It's our favorite strategy for buying market bottoms. It works extremely well. When it comes up, you don't even second guess it. It averages about 88% winning trades in that neighborhood. Um, and usually the market's been volatile. The market's been dropping. Targets of volatility is big, which means the targets are big, which means when you take that trade, your first profit objective will be more profitable than if the markets had been just steadily going up. So when that Ichimoku hook comes up, you don't hesitate. You push the button, get into the trade, manage the position as we show you. And this came up, and all the hooks came up at the same time. Beautiful trading. Some people could not do it because they were letting the news influence their 100% objective trading. So some people just watched their other trades with time decay. They took their 25, 30% loss, a little drawdown in the account, and then did not have the offsetting wins to make everything actually profitable in the account. So I had several people who missed all these beautiful trades going long, um, and they just missed out. And they could go back and learn. So yeah, we should have done it. The people who did do it are the people who have been working with me for quite a while. They're like, yeah, baby. Um, and Gabrielle, I think do you remember Steve who was at the meeting last Saturday? He's one of those people. He was sitting in the front until I introduced him as one of my coaching clients. He was in all these trades, and he's been trading with me since 2007, doing all these strategies. So he knows when it comes value, you just take the trade. All right. So, any questions so far? I really want to spend some time on just the last couple of weeks or months. I want to take a quick look at the chart also from that time period. I'm going to
Will
change the
we
share. Yeah.
will we go over the Ichimoku hook? Like, will we be able to see what that looks like?
Say that again.
Will we be able to see what the Ichimoku hooks strategy looks like in real time?
The Ichimoku. Okay. Everything we do is end of day. So it's not when the market is open, it's when the market is closed, and when we do our analysis. So we do our analysis in the afternoon or evening when the market is closed. Today, I'm not going over the Ichimoku hook only because that is a special one for coaching clients only. But I am going to go over another one of the strategies that is probably everyone's favorite strategy who's ever traded these things, and it's extremely, extremely high probability trade. But Ichimoku hook, I say purely for coaching clients. I'm actually going to go over the Danshin cross, and I'll take a look at the super trend. The super trend is one of these that hit beautifully on April 1st. I'm going to take a look at that. I'm going to switch to that. And then we go over some of those trades. All right. So you should be looking at a chart right now. This is the QQQ, the NASDAQ. I think I went over this a couple of months ago during one of the meetups. It's one of the a very it's a strategy where we're looking to for the market to have been pushing lower, pushing lower, pushing lower, and then start going up. It's an early buy signal. So these are Bollinger Bands, and this is a Donchian mean line. You don't have to know what those are right now, but what we're looking for is the market to make a multiple standard deviation move lower. So upon making a multiple standard deviation lower, we're looking for something to show the market is now turning around. So how this works, the market is pushing below these bands, two standard deviations or more lower, and then we look for the first candle completely above this Donchian line. That's our trade signal right there on April 1st. And we're looking to buy a market bottom following a pullback. It could be a deep pullback, it could be a shallow pullback, but after a pullback. This is on daily charts. It's a simple strategy that works extremely well. Here was another one right here. Pullback, it went below the wick went below the bands, and then there's the first candle completely above right here. And it went against us for about 5 weeks and then took off.
Why are
So
some
yes,
like
yeah,
hollow bars instead of solid bars?
because there's an indicator on this chart that colors the candles red or green, regardless of whether it's an up day or down day. So the open candles where it's open in the middle, those are up days, and the ones where it's filled in, those are down days. But
Oh,
indicator I have on here just colors them, give them a directional bias. So because we use this chart for multiple purposes. So one of the purposes is where we use the super trend indicator colored red or green.
so the difference between the solid and the hollow is
The hollow is an up day. So the market opened down here and closed up here. And the filled in, the market opened up here and closed down here.
but there's also filled in green ones and
Yes,
red
filled in
ones.
just means it opened up here. It's a down day, opened up here and closed down here.
Uh-huh.
So, and like I said, it doesn't, for this particular chart, it doesn't matter if it's red or green. A open candle is an up day, a filled in candle is a down day.
Mhm.
The color just gives it the whole overall thing a directional bias. Sometimes if you wonder if something works, you go like this. Hmm. When it's mostly red, is it going down? And when it's mostly green, is it going up? This is how I sometimes do like a quick evaluation if a strategy is worth my time evaluating. So let's see, when it's green, it's going up, green going up, green going up, green going up, green going, this might be worth my time. So that's how I do a big picture evaluation when I learn about a different type of strategy or trading. I do something as simple as that. I get all the settings in, I just sit back and look at it. And wow, every time this thing turns green, I got a pretty good up move going on. So now I know I have something to work with. And now I can go in and put some rules to it and test it and see if it's really worth doing or not. And that's how I always do testing analysis. You do a big picture look at it and then get into it and then go back 20 something years.
Hmm.
So let's take a quick look at what kind of profit to expect when you do this type of thing. I'll use this as an example. It went down below the bands, and our first day above is, let's say that low is, you take a look at data box to see the actual numbers, everything is color coded. So the low of the day is 597.32, and the orange, I'm using orange five. So this low is below this yellow line. So here is the first candle completely above. Okay. So you'll see on the chart it says ATR is 13.63 or 13.63. That ATR, and that's right over here, average true range, is the volatility of the NASDAQ that day. It means on average, every 5 days, it's moving 13.63 points on average. We use that as a profit objective. And we have a list of stats that say, okay, whenever we get this trade valid for the super trend, we know it's going to be 85 to 90 something percent probability of success if I take this trade with options that it's going to move up at least 13.63 points within the next 1 to 3 months. We know that based on history, and we maintain those stats every 3 months. We update those stats. We meaning Becky. So
What
yeah,
what does the orange dots mean?
okay. The Bollinger Band, these are Bollinger Bands, and Bollinger Bands are a measure of volatility. So are you familiar with standard deviations?
No.
Okay, so um, statistically, things move so much before returning to what is normal and average. It'll move so much, then return to what's normal and average. And that's the same as everything we do in our day-to-day lives. Something will move, we go this much, and then we return to normal. That could even be like exercise and heart rate. We spikes up, heart rate spikes up, and then it returns back to normal. And if we track that over time, we see the standard deviation, it'll go up and down in a range, but it'll spike up to an extreme and then come back down to an average. So these Bollinger Bands represent extremes. The market will spike up to the extreme and then it'll eventually pull back and stay within a range. It'll spike up and then pull back. It'll stay see it's how it stays within this range, and then it'll spike up and then pull back. So we make use of that every time. So, and how are we doing it with this strategy? It'll go down to an extreme move down. After an extreme move down, we need to look for something that tells us, okay, this market is now going back up to within the normal range. It's done going down. So this is from learning multiple types of technical analysis. It moved down to an extreme. And this first candle completely above tells us this extreme move down is now over, at least for the short term. And then now we can look at the upside move again. So that's what the Bollinger Bands basically do. And I can send you a video on that also.
Okay, thank you.
See, you're actually asking the questions that I know. I already have a preset email I send you out with the links to the questions I know you're going to ask,
Mm.
because those are just things we have to know when we start working with coaching clients. I send them a set of stuff for just to get familiar. Um, and a trade like this at a first profit target, you're looking at a 15 to 20 something percent return. So here it's ATR 13. It opens the next day at 616 and it went as high as 628. Um, so whenever it goes that 13 points above, it could take a week or it could take up to 2 months. When it gets there, that's when our order automatically takes profit. Well, let's go back to where we are right now. When this became valid on the first, it spiked up. Okay, that's our trade. Our ATR is 12.47. So we place our order the next day for our option. But this gap is what supercharges the profits. Okay. So being in this for the gap is what made stuff really, really profitable. There are different ways to manage positions, but this, if you stay in a position through this gap, your 15, 20 something percent return suddenly becomes 40, 50, 60% return or more. And if you trail stop losses, a trailing stop on this, then you can double, triple your money. I personally know someone who got in here and got out up here, and they got a 2.5 times what they paid for the option. So they made several $1,000s in just one option contract. Okay. Um, so it's opportunity, but you have to be willing to push the button to get into it. Some people got in down here and got out in the next day or two, and they'll get their 15 to 20 something percent return, maybe a little bit more because the targets are bigger and it's a quick move. So they might get a 25 to 30 something percent return. Some people kept in the position through the gap and stayed in this with just trailing stops. And they got really big returns. So you can make a little or you can make a lot, depending on how much work you want to put into it, how big your account is, how if you want to trail stops or not. Some people just take the quick profit, or some people will trail stops and stay in a position. So they're all valid approaches. It's a matter of how you want to do it and how much time you want to put into it. So I'm actually spending more time on this right now than I was planning to, but I want people to understand how money's made here. And if we were in this position over here for the first trade and it goes against us, here's where there was max fair. You might have, let's say you paid um, $800 for a contract and it will cost more for Qs because Qs it's more expensive. Let's say you paid $1,000 for this contract and it goes against you. Your target is ATR is 9.6, 9 point something. Your target's going to be up here someplace, but it goes against you. Your $1,000, what you see in your account, by the time you get down here, your $1,000 might be only worth 100 something, and you're freaking out. And you might have multiple trades on, and you think you're going to wipe your account out because it's all you see is this move going against you, against you, against you, and you're so focused on that one trade that it messes with your head. That's what was happening with a coaching client I had that was just messing with his head because he's looking at a single trade. And this is not a single trade. This is represents maybe 2% of the account. And it's only one trade out of a couple hundred for the year. So when we're trading, what I tell people that they have to kind of envision is not be like this, like blinders on a horse. Big picture. If we place 10, 20, 30, 40 trades, how many wins will be wins? How many losses? Will the wins be bigger than the wins? Excuse me, will the wins offset the losses to be profitable? The answer is always yes. Answer is always yes. But most people focus on that one trade that's going against them and forget about all the other trades that have been going on, that are going on, and will be going on. And they focus on one thing that's going against them. And we cannot do that with our swing trading. We have to be, as I say to everyone, place 7 to 10 trades a month and you will make money because the winning trades will offset the losing trades. The profits from the winning trades will offset the ones where you have a small loss from time decay. You can go back through any of our spreadsheets with the trades. We have it listed for the last, since 2019, at least publicly. And we have all the trades going back since 1999 or 2000 and is what we actually track and make the stats from. Pick any month, do a random sort on any month worth of trades. Any month, just take a random sort out any month and just pick 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 trades. I'm going to take those 10 trades. And you'll be like, wait a second, I would have had really good results no matter what I picked. And that's the thing. It's a numbers game. You have to play 7 to 10 trades a month and profits just sort of happen as long as you follow our pricing rules. There are going to be some trades which are not optimal, and I show you how to filter out the not optimal ones. I had one coaching client who took some not optimal trades and he took some minor losses, but they shouldn't have even been taken in the first place because there are better opportunities. So if you have 3 trades you can take, one is exactly as we've gone over, the pricing is right, everything is just right. But then you have 2 more. Well, maybe one you have to go out an extra 2 months to find an option. It was way too expensive, but you did it anyway. Or one you didn't give enough time because you found a cheaper option earlier, and those ended up becoming one ended up becoming a loss because you didn't have enough time. And other one, instead of making a 20 something percent return, you made a 1% return because you paid so much for the option you shouldn't have taken. You just tied up capital, lost money because you took trades that are not optimal. Those two trades could have been optimal a week from now, or 2 weeks from now, or 3 weeks from now. Those same trades could have been still in play and be optimal, but at this moment in time, they're not. If they're not moment, if in that moment in time they're not optimal, you pass. We have 20 to 30 something or even more trading opportunities every month for options, and so we're not desperate for trades. Take the optimal ones, pass on the ones that are not, note them. Just because it says 95% wins doesn't mean take the trade blindly in a bad situation. Wait for more optimal time to get a bigger profit objective, so on and so forth. All right, just wait and be patient. So I'm going to actually switch to another chart, and I'm going to switch back to the handout. Let's go over some of the stuff I had planned for today. Some of you have seen it before, but it's in the handout. Okay, those are the stats. Like I said, we just while I'm back on here is on our for the whole year so far. All the trades that are valid, ETFs. This is the strategy where we find market tops. Market tops. Squeeze. ETF squeeze, market tops. Every rally will end with this trade signal. That's why it's really important to be trading. Every rally will end with that trade signal. And every decline will end with this Ichimoku hook. So we find market tops, market bottoms. I believe in showing people how to do this themselves so they can do it themselves. And I've always believed in the old concept to teach people to fish so they can fish themselves. And I do email these trades out to everyone, all coaching clients every day, so they can compare what they found to what we found, so they can learn along the way. Then you're never on your own. I do that for a whole year. I email this stuff out to everyone for 1 full year from when they start working with me. All right, so now I'm going to switch back to the handout and go through one of the other strategies that I was planning to look at. Okay, and share. All right, so we already went through that first screen. The Donchian cross, some of you have already seen a Donchian cross. It's, I think, Becky's favorite strategy, some of the coaching clients' favorite strategy. And we'll go through this on the chart itself in a little bit. But it's that same two lines crossing type situation. The blue line is the 40-period moving average, and the orange line is the Donchian mean line when they cross each other. All right, so I'll go over that on the actual chart, but I just want to show you a quick example for the stats. I put two examples for people who are looking to do this, figure it out on their own. I just showed a couple examples for coaching clients. I'll go over this in detail with everything provided to you. As an example, he has a NASDAQ, the QQQs, trades going back till the year 2000. In that time, 51 trades, 47 wins, 4 losses. Okay. We trade 28 ETFs. So that list of 28 ETFs. So multiply this by 28 basically. So we have the stats for everything, and Becky maintains all of that. Here is the material sector, XLB. It goes back to 1999 also. 63 trades, 59 wins, 4 losses. Some of these will have a little bit of a win means the first profit objective was met. How much you make it a first profit objective will be dependent on several variables, which I go over with you. The biggest variable is patience. The more patient you are, the more money you make. So on any one of these trades, you can make anywhere from negative 20% to plus 50, 60%, even if whether it's as a win, just depending on what decisions you make. That's why I go over with people exactly what to expect and how to get the most out of it. The patience is the biggest thing. Another example, IWM, the Russell 2000. This goes back to the year 2001. 50 trades, 49 wins, and 1 loss. That's pretty good. That's why a lot of people like to trade the Russell 2000. Back when we were trading credit spreads back in the day, much more complex strategies, we used to trade the Russell 2000 and its bigger brother, the Russell, bigger index. The Russell 2000, we never had a loss on Russell. Never had a loss on Russell. This is a great thing to trade. So now I'm going to go back to the chart and show you a quick review of that particular strategy. But Russell is awesome. But this is how we trade. This is just follow rules and take the trades when they become valid. We don't speculate. We don't, well, I feel like I'm gonna, none of that nonsense. It's like when this, and this are all valid in a chart, and this, and this confirms it. Now we know we have a high probability, exact number, that what will happen next, within the next 2 months at least. We just place the trade, place the trade, place the trade, sit back. All right, I'm going to change the share to the screen. We'll take a look at this particular strategy on the chart. All right. So same idea as the other chart. Blue line is the 40-period moving average. This is a Donchian mean line. This is just a different setting. And what we're looking for is the orange line to cross above the blue line. It's very visual. So on this day, did the orange line cross above the blue line? No. And I just go through each list of the ETFs, click, 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 looking for a line crossing. The next day, did it cross? No. Next day, did it cross? No. Next day, no. Next day, no. Next day, no. Next day, no. Remember, you have 28 ETFs, so you might have other trades in other sectors, but this sector is S&P 500. Next day, nope, nope. Hey, that looks pretty close. Let me check that. It's too close to tell with your eyes. You have to look at the numbers. So you look at the data box. The orange line is 677.87, and the mean, the blue line is 97, so it still didn't cross yet. It's still below. Boom, it crossed. That's our trade signal. There are other little details to confirm it, but that's our trade signal. It's that simple, what visual you're looking for. I know I have people that have written some scanning software to find that. It's not that challenging on certain platform. What we're looking at now is NinjaTrader, and you can also do it on Thinkorswim.
I
The
don't
people
quite
have written.
understand.
Say that again?
I don't quite understand when you say the first one, it crossed, but it technically didn't. But then the next one, it did cross. Like, how does one know that?
Take a look at the data box, the orange and the blue.
Uh-huh.
Here's the orange, here's the blue. It's all matched up to the colors over here. So what's the value of the orange line relative to the blue line? You see the orange line value is less than the blue line? So the orange line is 676.87 and the blue line is 676.97. So the orange line is still below the blue line.
Oh, okay. Okay.
So when it was 1 day earlier, that's pretty obvious, right? But as it got closer, it was too close to visually just look at it and tell. So when it's too close to just look at it and tell, then we have to look at the data box to see what the actual value is. That's why we have the data box available to us, because we just can't tell with just our eyes. But when we look at it with a data box, so here's where we would stop and do a little closer looking. No, it didn't cross yet. Then 1 day later, now it's pretty obvious. The orange line crossed above the blue line. We have a setup. Now we go through, we check everything. We look at the stats. We see it's like 85 to 88% winning trades if we take this trade type of thing. And so the next day, at or below the open price the next day, the ATR this day is 6.63. That means on average, it's a measure of volatility. We're not measuring the volatility of the option. We're not doing that complex option analysis. We are using options as a way to capitalize on this opportunity. Okay. without putting big capital into it. And this limits our risk by buying a call or a put. So once I see this valid, I know I have an 88% probability that it will move 6.63 points within the next so many weeks. So the next day, I buy my option at the open. Let's take a look at this now. This is interesting. Let's say I bought my open I bought my option right at the open. And it immediately goes against me. So I just bought an option. It goes against me right away. So when you buy the option, it costs so many dollars, and then you put in your exit order. So you would take 6.63 and add it to the open price this day. So the open price that day is 6.79.89. You just add 6.63 to it. And somewhere here is where it's going to hit a target. Okay. Nothing to do. You just put your exit order in and walk away, live your life. You buy the call option, put in your exit order to sell that call option when the ETF is 6.63 points above this price. And that's good till canceled. Nothing else for you to do. The order will execute on its own when it gets there. But let's say you didn't get in right at the open. And you're going to get about a 15 to 20 something percent return is usually what you're going to get for that type of move. Not a big deal. That's pretty standard. If it gaps and moves faster, it might be a little bit more on gaps. Or fast moving market, it might be 30 something percent. But look what happened here. You get up, you weren't rushing, you have a life, you have a family, you have work, you do whatever you got to do, and you're not going to be in right at the open. Maybe you're not an early morning person getting up at 6:30 a.m. You have stuff going on. Maybe literally a little bit later in the day, you get a break at work. You open up your laptop and you take a look at what's happening in the market, and that's when you place your trade. This day, the market opened at 679.89 and it went as low as 671. So let's say if you got in right at the open, your profit objective would be the ATR from the previous day, 6.63 points added to the open price. And that's good. It'd be a nice profit, 20 to 30 something percent. But let's say you got in 5 points lower. By the time you got to it, you got stuff going on. The market opened and then it dropped. So instead of getting in at the open, which is 679.89, you got in at 674 something. So now, instead of your target being 6.63 points, you add on 5 more points to it. It's now 11 point something points higher. From here, your target is 6 point something points up, but you got in down here, so you get in 5 points better than expected. These are the most profitable trades where you get in at a better price than expected. So now your target is going to be 11 point something points from where you're getting in. This suddenly takes your profit from the 20 something percent into the 50 to 70% return at the exact same trade at the exact same price. The exact same trade. Instead of getting in here where you get 20 to 30% return, you got in 5, 6, 7 points lower because you got in at some point down here. Now your return is going to be in the 50, 60, 70 something percent return at the same exit point. Exact same trade. Okay. That's why multiple people taking the same trade will get in at different prices, different times, different days. And you had several days to get, you didn't have to get in this day. You could have gotten in here, here, or here, as long as you're getting in below this open price. So anywhere below that open price on this day, or this day. And if you're new to trading, some of this might go over your head. That's okay. This is stuff we learn as we go along, and I work with you. And then we do some from paper trading to some practice and go over the charts. And then once you're comfortable, we trade real money. That was represented some of the big trades that happened more recently with people getting in after the big move down and taking this trade up here. Remember when I said there was a valid trade up here, but someone got in? You could get into this same trade here is the same trade here, 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 here. The difference is the open price here is 680, 693. The open price down here is 652. Here you would have an 8-point target, 7.98, 8-point target. Here you would have a 48-point target. This same trade is still good down here. This same trade is still good anywhere below the open price. And I tell you, I know someone who got in down here on this trade. The target is still the same, but they got in 40 points lower. So instead of having an 8-point target for their trade, they got in down here and had a 48-point target. Same exact trade, but with a much bigger target. And they got massive returns on it because they took the exact same trade, but got in 40 points lower. Same trade. As long as it hasn't hit the target, it's still in play. The target stays the same. The probability of success stays the same. It's just that the entry is better. The person who got in up here,
It
they
is.
lost 25%.
How do you know what your target is?
It is the ATR of the day you have the valid trade added to the open price the next day. So on this trade, which we looked at on the other chart for the other strategy, the ATR 7.98, you would add that to the open price the next day, 693.28. That's your first target. And that would be hit somewhere up in this area. But once this trade is valid, it is good to get in anywhere down here. So you're not desperate to get into a trade. Some people want to get it over with quickly. Good, they get in the next day, but you can get in anytime you want. You don't have to rush. The more better an entry price you get, the bigger. If a trade is meant to be a loss, it's going to be a loss. But if it's meant to be a win, it just becomes a bigger win, a much bigger win. One win getting in at a better price is the equivalent of 3, 4, or 5 wins getting in at just the open. So opportunity comes with patience. And if you rush to get in, that's okay, but you won't get as you might miss some trades if you wait. But the ones that are like this and you get in late, those are the ones that end up becoming the big winners. But some people get become afraid and stop. I can't. It's going down. It's going down. It'll never go back up again, ever again. Trust the probabilities of success and place the trade. So this was a good example here of you get in right at the open, great. It'll be a good trade. It's target's hit a couple of days later. Get in lower, great. It'll be an even better trade because instead of 15, 20 something percent return, you're going to get a 40, 50, 60 something percent return at the first target within about a week. Exact same trade, better entry. This strategy comes up, the Donchian cross comes up all the time. Here we are, Donchian cross. Once again, all we do is looking for 2 lines crossing. Most of our option strategies involves 2 lines crossing for the visual recognition, or you write some scan to find it. I know several people who have written software just to scan for these 2 lines crossing. That's what you got to do for, and there's some other criteria, but scan for the 2 lines crossing. There it is. That's the cross. So one day earlier, nothing valid yet. This whole time, nothing valid, nothing valid, nothing valid. Once you see nothing's valid, just move on. Next ETF, next ETF, next ETF, next ETF. If something valid, stop and evaluate. Otherwise, just click, click, click. It's very visual. So I can personally, I can evaluate 28 ETFs on 8 strategies within 5 to 7 minutes because I'm just looking for 2 lines crossing or change in color or hook. So it goes really fast. But one day later, crossed. Now I know I have that 85, 88, 90% probability if I buy my option at or below the open price the next day that it's going to hit, and the ATR this day is 10.38. That is going to move at least 10.38 points within the next 2 to 3 months. If it moves fast, great. If it moves slow, great. Faster it moves, the more profits you make usually. Slower it moves, you make good profit, not as much as a fast-moving market. Fast-moving markets are the best. you have any questions on this? It's one strategy. It's the one I've featured into the meetup, but I wanted to go over a lot of the stuff from the past couple of months also for today so people kind of get a feel for time decay, which was about 25-30% on the options that were valid back in February. They all hit targets. They literally hit targets on expiration Friday, which was April last week Friday. 17, here it is. This was last week Friday. So between our different strategies we had trades that were valid um in the February, from the beginning of February and all the way to the end of February. We had long trades that were valid. We had a couple of different long trades valid back here that all went against us, that looked like, and down here, all those trades, we had a couple of trades in different sectors that went against us, and it looked bad. It was like trade here, another trade over here, and a couple more in other ETFs, and they were just going totally against us. And but this is how I stay calm usually with that big picture monthly chart. I saw where we were, and that's when I was telling people get long, get long, get long, get long, get long. Then once we had our first buy signal, that was on April 1st, we got our buy signal, go. But a lot of people were still afraid because they saw this going down, and they were sure that the account's going to be wiped out because we had multiple long trades, each tying up 2 to 4% of the account, and they were like, "I have like 10 trades on. I'm gonna lose my whole account if I don't. I can't put any more money into it." You'll only lose your account if you stop trading. You have to take the valid trades because it just takes a couple handful of trades to really negate all previous losses and drawdown. It's just consistency, and I'm all about numbers. I don't care about news. I remember the first time I told Becky, she got shocked. I told her, I don't care about your feelings. And then she understood exactly what I meant. I mean, I don't care about your feelings, but this is business and trading. Your feelings mean nothing. Trade the plan, trade the objective numbers, and you make money. When it comes to trading, I don't care about feelings. Feelings just keep me from profiting. It makes me lose money. See, I have a question in the, do you backtest these strategies? And if so, what is the historical return profile? You can only backtest options up to a point because 10 different people taking the same trade will get in on 10 different days at 10 different strikes at 10 different prices of the underlying. So we had to do this. It's not by just back test, it's by forward testing. We've been doing the same type of trading for 19 years with basically the exact same trade management for 19 years. So we know what to expect. Um, we know what option pricing to use when just buying calls and puts. That's a certain formula, I'll say, for coaching clients. So if I'm working with one of you, I'll tell you what you should be paying for the option and what option price is too much. We go through how much time. You'll see exactly how much time should be in the option and the pros and cons of 1 month of time versus 2 months of time type of thing. You will see the win-loss percentages. And we consider a win when the first target is reached before expiration. Um, how much you're going to make will depend on certain decisions you make on your option selection and pricing. You can take a perfectly good trade and mess it up by choosing the wrong option. So that is why I go through that with you. And I really encourage people to make, be willing to pass. If something says 98% wins, an option you're looking at is not just perfectly priced, it's not the right expiration date, it's just not the right open interest. Even though it says 98%, at that moment in time, since it's an option, you pass. Wait, there might be a better opportunity a week from now or 2 weeks from now to take that exact same trade at a better price with a better situation, and then you really capitalize on it. But you make good decisions. The trade's still valid. You take it right now, you might make a 1% return on it, a 2% return. You wait 2 weeks, you might make a 20, 30, 40% return on it. It's that big a difference. Nothing, since there's options, there's so many variables, we have to be selective. And with 20 to 40 something trades a month available to us, we can be patient and wait for a better opportunity. All right, so anyway, the Donchian cross is the strategy that we quite often show, and it works extremely, extremely well. It comes up everywhere on everything. I can change symbols real quick. I can pull up, let's say, home builders, XHB home builders. Crossed over here. It went sideways for about several weeks and then just took off. And it happens over. I didn't even look at the stats on it. It happens over and over again. If we see it close above the Bollinger Band on the crossover day, we don't take it because it tends to pull back. So this would be a no trade. It closed above the Bollinger Band. So we don't take that. So we look for ones that don't close above the Bollinger Band on the crossover day. Close above, we're not taking it. This one closed above, pulled back for a couple of weeks, and then took off. Like this was just about with any of the ETFs because we have stats for everything. I can pull up retail, XRT, retail sector, crossover. It's just visual. You just look for the crossover and you take the trade. Didn't cross, didn't cross, didn't cross, didn't cross, didn't cross. Hey, it looked like it crossed. You're not really sure. Too close to tell. Look at the data box. Let's see, 868.19. Yes, it crossed this day. Good trade. So that is the Donchian cross. It's I know a lot of people's favorite strategy. It works really well, but we trade long, we trade short, we trade up, we trade down. We don't pick direction. The charts tell us and the strategies tell us what to trade. So that is why we don't dictate to the market. People think they can tell the market what to do. No, we learn from a lot of people. Myself and Becky travel around the country learning from people who trade their own real money, and we learn from them. I have to wrap this up in a little bit. And we learn from them and the methods they actually use. And it works. So what we've come up with is a strategies that is a combination of many, learn from many, many people all combined and how to manage it, how much the risk to put in every trade. We should never lose more than 2% of the account if something goes horribly wrong on a trade. I know people who wipe out 20, 30, 40, 50% of their account on one trade. And it's like, you have to understand the reality. At some point in time, you might have three, four losses in a row. And if you have three or four losses in a row, it should not injure your account. But a lot of people don't really even know that. So, I know we're gonna have to wrap this up pretty soon. Do we have any questions on anything so far? Look at a chart if you want, or I'm gonna switch back to the handout and start wrapping up. Let's see. So if you go back and take a look at some of the recordings in the YouTube channel, then you will see some on the Dacian. The detailed stuff I have to give you during meetup, during coaching sessions. I provide all the charts. I provide everything you need, all the stats, the plans, the details, go over that with you. And it's not an overnight thing. It's something that takes a while, especially if you're new. It's not overnight. If you're brand new, give yourself at least half a year to get a routine down and understand it and be comfortable. Because when it comes to money, it's a mental game. It's the technical part is I can teach anyone the technical analysis in a couple of days. That's the easy part. You can look at a chart, you'll know all the ups and downs, when to get in, when to get out. That's easy. But you have to be in it. You got to be in it and doing it and to appreciate the mental aspect of trading. It's not, it's challenging, but once you get to a certain point, boy, is it sweet. It's what allowed me to walk away from my full-time job at Lockheed and have income from coaching to make sure I have a roof over my head and like hot water and a car to drive and everything else, pay some bills. So it's also nice supplemental income. And if you're starting out younger, um, it's nice to start now and keep building. So anyone who wants to work with me, I have a coaching special for April. Let me know before the month is over. I do everything one-on-one. So these are the regular prices down here. It's also on my website, the regular prices. I'll take 250 off the futures program, 250 off the options program. If you're doing both, I'll take 750 off. Um, and I put it out there for those of you who were at that event last week, Saturday. There's a little bit of an extra discount on top of this for you. So if you were there last week, Saturday in Oakland, just remind me, and there's an extra discount for you. So uh, let's see. Some of you may not have seen that, but let's see it. So just change the share real quick to the website. Okay, share. All right, so my website, so you can also contact me off the contact page, or my email is on the handout, also phone numbers on the email. This is what we did last week, Saturday of this event. So if you were attending this event last Saturday, let me know. There's a little additional discount for you. Just remind me you were at the event. So message me and I'll give you an extra discount off of what I'm showing in the handout, which I'll switch back to. Let's see. Same phone. All right. So, but yeah, so all the details are here, and detailed details on the FAQs page on the website has much more advanced detail. Everything is one-on-one coaching, and we update the stats for everything and trading plans every 3 months. The strategies don't really change very much because they work. We've added some strategies for just the S&P, NASDAQ, and Dow because some people like to just trade those and nothing else. They're a little bit more expensive, but they give you great results. And everything one-on-one, usually 1 to 2 hour long sessions. And it's whenever we have a mutually agreed upon days and times. So I'm usually pretty flexible in evening and some mornings. Same thing with the futures program, 1745 minus 250. Um, and if you haven't watched any of the videos online, watch those also. Give you a feel for those. If you're combining them, that's a normal price for the combined options, and futures is just the same. There's two prices combined, added together, and I'll give you the 750 off the combined. It just takes time to learn everything, so don't be in a rush. Everything this is a business. And it takes time to learn it and to learn to think like a business. And you don't watch a YouTube video and suddenly become a trader. The people who watch a YouTube video and suddenly become a traders, those are called my future clients because those are the people who contact me because they lost all their money eventually and contact me to actually learn how to trade. Okay. Um, so, what if we have gone through program in the past, long time ago? Let's see. Um, can you define exactly what you mean, Serena? If you want to unmute.
I went through your program maybe like almost 10 years ago.
My program?
Yeah.
You were one of my coaching clients?
Yes. And I guess I couldn't figure it out quite back then, but I'm wanting to try again.
Where did we meet?
At your, was it jujitsu studio, or are you still doing that?
Yeah.
Oh, okay.
We met one-on-one.
Yeah. I'll I
I
send you a message.
I will email me later or give me a call.
Yeah, I actually tried to send you a text. I don't know if you have text on your phone.
Was it recently?
Yeah.
I'm not sure. Email me and or call me.
Okay.
And let's talk.
Okay.
I'm not remembering the name Serena, that name,
Yeah.
but if we did something, let's take a look at it.
Okay. And you're at 404-556-7181.
Yeah, that's my number.
Okay. All right. Thank you.
All right, cool. All right. Then I'm going to wrap this up now, unless anyone has some questions, and then we will get back to probably the next meetup in maybe a couple of weeks. I might be changing my times. It might be going either Wednesday evening or later on Sunday in a couple of weeks. So rather as opposed to 12:30 p.m. So it might be a little bit of a change in time and or evening on Wednesday. So stay tuned. Or give me a call or message me, email me about the coaching thing. Let me know by this coming Thursday. And otherwise, we'll see you all in a couple of weeks for our next meetup, which will probably be on futures. All right. Thanks a lot.